Hello, welcome to yet another exciting and all important video. To me, this is one of the most important videos, and so I have decided to entitle it Before You Place a Trade, with special reference to risk management. So without much ado, we move straight into action. In this video, we shall be discussing the concept of risk to reward ratio. In other words, ROI multiple, and the relationship between these and the win rate. Both the risk to reward ratio and the win rates are the key factors of a profitable forex strategy. We shall also discuss what fraction of your equity or balance should you risk per open positions, how to determine the appropriate lot size for your position or multiple positions with reference to position size calculators or the Steno Android app. We shall be looking at stop loss range and how it affects the percentage risk and reward. We shall also look briefly into the concept of losing streak and drawdown. We look at a case study of risking a small amount of your equity versus a big risk. Then lastly, the bonus concept is the triangle of trading success. Quickly, let's look at the concept of risk to reward ratio / ROI multiple and win rates. What do we understand by risk to reward ratio? For every trade you place, there is always risk associated with it. And so it is important for all traders, for every trader, to be able to define the risk before placing a trade. For instance, you may say, I only want to risk 1% or 2% of my account, or I am only willing to lose $100 or $50 of my account in this particular trade. Now that is a risk. Now we also have a reward. In most cases, it is advisable that the reward should be greater than the risk. For instance, if you are greater or equal to the risk, if you are risking $100 in a trade to win $100, it means that your risk to reward ratio is 1:1. But if you are risking $100 to win $300, it means that your risk to reward ratio is 1:3. Now, what is the concept of ROI multiple? Very simple. For a risk to reward ratio of 1:1, the ROI multiple is 1 arrow. For a risk to reward ratio of 1:3, the ROI multiple is 3 arrow. For a risk to reward ratio of 1:2, the ROI multiple is 2 arrow, and so on and so forth. Now the next thing we shall look at is the win rate, and this is actually the percentage of your winning trades. For example, if a particular trader usually wins 30 trades out of 100 trades placed, we can say that the win rate of that strategy for that trader is 30%. Okay, that's the win rate. If the trader usually wins 70 out of 100 trades, we can say that the win rate of that trader is 70%. If a trader wins 7 trades out of 10, we can also say that the win rate for that trader is 70%. Both the risk to reward ratio and the win rate should complement each other. This means that if your risk to reward ratio is poor, your win rate should be high in order to be profitable. And if your risk to reward ratio is high, most likely your win rate will be low. But if both the risk to reward ratio and the win rate is low, then it becomes a recipe for disaster and not advisable. Let's look at one example. This particular trader has a win rate of 30%. For example, he is capable of winning 30 trades out of 100 trades placed. Win rate of 30% is generally considered a low win rate. But let's see what his risk to reward ratio is. Actually, it is 1:3 or 3 arrow. It may mean that this trader is risking only 100 USD to make 300 United States dollars. So generally, a risk to reward ratio of 1:3 is considered very good and high. So you can see where these two factors complement themselves to give you a good strategy. Let's go further to see if this strategy is profitable or not, combining the win rate and the risk to reward ratio. So a win rate of 30% means that the trader can win 30 trades and lose 70 trades out of 100 trades. Okay, and the risk to reward ratio of 1:3 means that for every time this trader loses, he loses 100 USD, and for every time the trader wins, he wins what? 300 USD. So therefore, we can calculate the wins in USD to be equal to 30 times win times 300 USD to give us 900 USD, and the losses in USD will be 70 times 100 USD to give us 700 USD. So the profit, of course, in USD will be equal to 900 USD minus 700 USD, and that will give us 200 USD. So for instance, a 10,000 USD account, we have a percentage profit of 200 over 10,000 times 100, and that will give us 2%, which is actually a very good percentage gain. So what fraction of your equity or balance should you risk per open positions? The short answer is never risk more than 2% of your account size. Okay, never risk more than 2% of your account balance or equity. This is the general advice. But then I must say that risk is can be expressed in terms of percentage and as well as in terms of the dollar value. For instance, a trader can say that based on his equity that he cannot risk more than 1% of his account, or the trader may say, this time not using percentage, the trader may say that I am not willing to risk more than $100 of my account. Okay, so what I'm trying to say is this: the risk can be expressed in terms of percentage or in terms of dollar amount. You can agree with me that 1% of $100 is just $1. Okay, and the same 1% of $100,000 is $1,000. So you can see how big the 1% is looking now. $1,000 is not easy. So a trader who was used to risking 1% in a small account may not be able to risk 1% in a much bigger account. But if you ask me, I will say do not treat the dollar amount, but look at it in terms of percentage. If you begin to look at it in terms of the dollar amount, you may not be able to trade very well. So such trader who may not be able to risk 1%, which is $1,000 of a $100,000 account, they decide to say, well, I want to risk $500 instead of $1,000. So at the end of the day, the trader will now end up risking 0.5% of his or her account. For me personally, I usually risk 1% of my account, and so many traders are also fond of doing that, risking just 1% of their account, between 1 to 1.5% of their account. But as a general advice, we should not exceed 2% of our account. Does it mean that people who exceed 2% of their accounts are not profitable? No, some of them who are high risk taker can also be profitable, but as a general advice, please do not risk more than 2% of your account in order to stay alive in this business. Now, since we have known that we should not risk more than 2% of our account, it is very important for us to be able to determine the appropriate lot size for our positions in order to ensure that we do not risk more than 2% of our account. And that is where the position size calculators, or we can also make use of the Android app known as Steno, to achieve our desired results. Before we proceed, I would like to make us understand that one thing is very important in terms of risk management, and that is stop loss. How do we actually determine our stop losses? It differs for various traders, and even for the same traders, they may use different tactics in setting their stop losses. Some traders have what we call fixed stop losses. For example, if they are trading on the daily time frame, they may want to use 100 pips stop loss. If they are trading on the 5 minutes time frame, they may want to use something like 5 pips stop loss. These are fixed according to them. While some other traders can obtain their stop loss. Their stop loss is based on a particular multiple of the indicator known as the average true range. Some other traders can use the average true range to set their stop losses. Why some will always want to put their stop losses just above the high or low of the candles, depending on whether they are buying or selling the pair. Like in this case that you are seeing, this trader decided to, okay, let's just analyze the trade then before we get to selection or fixing of stop loss. Now you can agree with me that this trade is making lower lows and lower highs and lower lows, and by the time it makes a lower high, by the time the market breaks this low at this point and retest it, and after retesting it, it rejected the 50 periods moving average, reject it. That is why you see these wicks. These are signs of rejection. And after we have two rejections, rejecting the level and the moving average, what did we notice? The third candle that formed was a bearish engulfing candle. So as part of the trader's strategy, he took the trade here, placed his entry here, and took the stop loss above the most recent swing highs and targeted about a risk to reward ratio of 2. Okay, so that's how this trader succeeded in placing the stop loss, and eventually the stop loss gotten in this case is 75 pips, and the target is 150 pips. 150 over 75 will give us 2. That is how we get the risk stroke reward ratio of 2. Okay, so that is it. Why am I saying this? You need to have your stop loss for you to be able to make use of either the Steno app or your position size calculator. You need the stop losses. So it depends on you how you actually generate your stop loss. So having generated your stop loss, we move on to what we call the position size calculator. As you can see, this is how simple it is. We have the account currency, the currency in which your account is expressed. Most likely it is in the United States dollars. Then the next item there is your account size, which for instance is $50,000. The next item is your risk ratio, which is actually 1%, and your stop loss pips is 10. But if we were to use this, our stop loss pip would have been 75. But don't worry, it's just for illustration purpose. Contract size is 100,000, and the currency pair we are treating is actually what? Euro USD. So after imputing all these values, you click calculate, and the results will be displayed below. What did we see? It means that we are willing to lose just $500 of our account, which is an equivalent of 1% of $50,000 balance, and we are willing, the lot size that we are to use in order to achieve this minimum risk is now 5.000. So it means that if you make use of this lot size, there is no way you can exceed $500 eventually if the market goes against you in a loss. So having said that, if you look to the side, you will see switch to money. Like I did say, the risk can be expressed in terms of percentage or dollar or money value. Okay, so instead of expressing our risk in terms of percentage, we are going to express it in terms of money. What it means is that a trader might decide to say, I don't want to risk more than $500 of my account. So in that case, instead of using percentage, we click on this. It gives us the next position size calculator. Now we have money here instead of risk percentage. It is now money in USD. Okay, so like before we have USD, like before our account size is $50,000. Now we want to risk only $500. Our pips remain 10, our pair remains Euro USD. By the time we calculate, the resultant effect is that we are using just 5 pips, sorry, just 5 as our lot size in order for us to achieve this minimum risk that we've placed here. So it's very important for us to know that if we do not know and we use a wrong lot size, we may not guarantee that we will stick to our minimum risk. Okay, now we are going to look at the concept of stop loss range and how it affects our percentage risk and reward. It may interest us to know that when we talk, okay, firstly, when we talk about stop loss range, this is what we mean. A stop loss of 10 pips is a very small range or a smaller range compared to a stop loss of 100 pips or a stop loss of 50 pips. Okay, these are the range. So the smaller the pips for the stop loss, the smaller the range. And the fact is this: the stop loss range does not affect our risk. The risk is fixed by the trader. If I say I want to risk 1% of my account, it doesn't matter if I'm using 10 pips stop loss or 100 pips stop loss. All I need to do is to readjust the lot size in order to give me my 1% minimum risk. So the stop loss range does not affect the risk amount. But what the stop loss range does, it affects the reward, and thus it affects the risk to reward ratio. So for a smaller pips, let's say 10 pips, the risk to reward ratio will be higher when compared to a bigger stop loss pips. As you can see here, if you take note of this, you see that the market is making higher highs, higher lows, higher highs, higher lows. And because it is touching this 50 period SMA, it's a very good opportunity to place a buy. When the market touches this 50 period moving average, is referred to as an area of value. An area of value is where you place a trade and most likely you will hit profit. Okay, so whenever we have a situation like this, it becomes an area of value. Then the next thing is for you to wait for a bullish candle. Like in this case, we have this bullish candle, and that is what the trader saw when he entered here for a buy in this particular market, Euro USD. Okay, and the trader set the stop loss to be what, 10, and the take profit to be 30 pips, and eventually that gives us, or that gave us a risk to reward ratio of 3. Okay, so look at this very well. You are going to compare it to the next slide. The risk to reward ratio of 3 simply means that if this particular trader is risking $100 the trader is capable of getting $300 as reward. Now for the case of increasing your stop loss pips from 10 to 15, the target remained the same. You can see that the risk to reward ratio has now reduced to 2. What it means is that the trader who was capable of receiving $300 profit is no longer capable of doing that, but instead will now be able to receive just $200 profit. So you can see that the stop loss range can affect the profit and also what we refer to as the risk to reward ratio. A bigger stop loss range will lead to a smaller risk to reward ratio and smaller profit. A smaller stop loss range will lead to a bigger risk to reward ratio, and that is why most traders, they like the term sniper entry. When you hear sniper entry, it is simply telling us of the fact that the stop loss pips is very tiny compared to a very large take profit pips. Okay, so it means that a sniper entry simply means a very high risk to reward ratio. Okay, now we are on to the concept of losing streak and drawdown. What do we understand by losing streak? By losing streak, we mean series of losing trades, and this is common with every trader. There is no trader that will not experience series of losing trades, which in other words we mean when you have a series of consecutive loss. For example, for 6 trades you are losing each and every one of them consecutively. Okay, we refer to as 6 losses in a row, 5 losses in a row, 4 losses in a row, 3 losses in a row. These are losing streak. And losing streak leads to what we call drawdown. A drawdown is actually a depletion of your account, a reduction of your account. For instance, a particular trader has a $1,000 account, okay, and the trader experienced a losing streak that made him to lose $500 out of that account. So we can say that the trader has lost 50% of his equity, and the drawdown can be rightly be expressed as 50%. Okay, so we can say that the drawdown is 50%. And now, because this losing streak is very common for every trader, it is very important for us to manage our risk very well. A trader that is risking just 1 to 2% will not have so much problem with drawdown. Okay, will not have so much problem with drawdown even after countering losing streak. So let's try to get more illustration about losing streak. On the first column there, we have loss of capital, which is also equivalent to the drawdown. So if you have a drawdown of 10%, which means you have lost 10% of your account, before you can get back to your original balance, you need to have an 11% win rate. Okay, if you lost 20%, before you can get back, you need 25%. If you lost 50%, before you can get back, you need 100%. Dear friends, let me be frank with you. Even 11% win in Forex is very difficult. So it is important for us to know that all of these are too high for us to lose in our drawdown. if your drawdown is 10%, you've lost 10% of your account, it's very difficult for you to come back to that original balance. And that is why, as traders, it is very advisable for you to know your maximum drawdown limit. Okay, when that limit is achieved on a particular day, it is best to stay out of trading and go back to re-strategize and come back hopefully and do something better. If not, you will end up in a place where you cannot come back. For example, somebody who has lost 50% of his account, we need 100% to come back, is a very difficult battle. Now we're quickly going to look at a case study of risking small versus risking big. On the first portion, we have those in white color. This trader is actually risking 2% on his trade, while this trader is risking 10% on his trade. Both of them were given $20 each, and assuming that they have a losing streak of about 19 trades, that is, they lost 19 consecutive trades. This is just an assumption, because normally it should not be possible for traders to lose consecutively 19 trades. That means that trader is not serious at all. Okay, now even after the end of 19 consecutive losing trades, the total balance for this trader still remains $13,903 compared to this trader, which is $3,002. For this trader, I think he has succeeded in blowing his account, but why this trader is still very much alive in the forex trading business. Now consider this: after 6 losing trade, which is very practical and possible, this trader is still having 18,000 out of the $20,000, while this trader has lost almost half of his equity after just 6 losing trades. Okay, so like we said, that trader will require about 100% to get back to break even, which is usually very difficult. I believe that this concept is clear to you. Then lastly, we are going to be looking at the triangle of success, or trading success, which I term as a bonus video. You can see the triangle, and inside the triangle we have dollars, and that is those who are profitable already. And what will actually give you that edge, what will actually make you a profitable trader? The first thing you need to consider is your strategy. Remember, we said the 2 main factors of our strategy is the risk to reward ratio and the win rate. They should be good enough to give you a profitable strategy. Now the truth is that my forex basic course, we actually equip you with forex knowledge that you will make use of in formation of your strategy, or better still, adopting a strategy for you to be able to trade the market. You know, you need a very good strategy. Most traders do not have strategy, and it's a total kind of disaster for them. You don't approach the forex market without a strategy, you can hardly be successful. You should have a strategy that you have tested and you have proven, and you trust that strategy that it will be able to make that is a profitable strategy. Okay, so it's very important. Strategy is the first key. Strategy is very important. After you have a very good strategy, the next thing is to do what? Is to have a good risk management plan. Risk management plan is another key factor of our triangle of success. Like we said, or we have been saying, do not risk more than 2% of your trading account, and that is a simple risk management plan. Risk management plan, actually in forex, let me just be sincere with you. Forex is not a get rich quick scheme. What it means is that you cannot become rich after placing 2 or 3 trades. That is gambling. If eventually that happens, I tell you, in the next few days you are going to lose all this money. So forex does not operate like gambling. It's a business and you must treat it as a business. So in other words, in forex, how do you win? You win by allowing the number game to play in your favor. You win by taking series of trades, and after those series of trades, that is where your profit will be coming from. Okay, it's not just from 1 or 2 or 3 trades. Okay, and now it means that as a trader, for you to trade your strategy profitably, you will take series of trades, maybe 20, 30 trades, 50 trades, 100 trades, before you can begin to see some profit. And now, if your risk management is bad, like we have seen in this case, the risk management is bad, it means that after some time or very few number of trades, you are out of the market. It will not give you the opportunity to trade the number of trades that are needed for your strategy to play out. And that is why risk management is very, very important for you to stay longer in the market, to continue to trade your strategy so that the numbers will be in your favor at the long run. So risk management is key when you talk of triangle of success in forex trading. The last concept that is very key is trading discipline, and it happens to connect the other two, strategy and risk management. What is trading discipline? Some textbooks have defined it or tried to specify it as being rock solid discipline. And when they say rock solid discipline, I will not blame them, because it's very difficult for us to be really disciplined in terms of trading. Very, very difficult. And that is why most traders actually fail. They lack the discipline that is needed to succeed in forex trading. I'm talking about the trading discipline. Is actually ensuring that you trade your strategies continuously, consistently. Consistency is the way of success in forex trading. Now, discipline will ensure that you do not jump from strategy to strategy to strategy to strategy. That is the beginning of your troubles. Okay? Some persons, if their strategies are experiencing losing streak, you see them jumping from one strategy to another, from one strategy to another. That will never help them. And that is why it is good for us to have back-tested our strategy, make sure that we trust our strategy, such that even though we are experiencing a losing streak, we trust that our strategy at the long run is going to make us profitable. So trading discipline ensures that you do not jump from one strategy to another, because that will never help you. Also, trading discipline ensures that you keep to your risk management plan. For instance, you are not willing to risk more than 2% of your account. If you are not disciplined enough, there may be times where you may decide to risk up to 5 up to 10% of your account, and that will just bring disaster for you. So trading discipline ensures that you stay within your risk management plan and you continue to trade your strategy consistently. It was Bruce Lee who said that he is not afraid of the man who has 1,000 strategies that has not properly tested them, or that has not properly trained or mastered those strategies. But rather, he is afraid of the man who has one strategy and have mastered it over time. So forex is a game of mastery. It's a game of mastery. You need to master the strategy, know it very well, and by the time you know it very well, you will trade it profitably. Okay, so that is the triangle of success. Don't forget strategy, risk management, and trading discipline. Talking about strategy, it has to be rules-based strategy so that you will be able to eliminate emotions. You will have a clear-cut action. Okay, now talking about rules-based strategy, for example, your strategy will have some certain conditions that say maybe 5 of them, 5 rules. If those 5 rules are not met, are not satisfied, you don't pull the trigger for a trade. That's how we trade. So we call it the mechanical trading system. It can be divided into 4 parts. The conditions. What are the conditions you see for you to say I want to take a buy or I want to take a sell? These are the conditions. Then the entry. What are the indicators? What are the things you will see for you to say, okay, it's time for me to enter this trade? If you don't see those things, you don't enter. Some people use a candlesticks pattern, some use various chart patterns and all that. Those are the things they see for them to enter the trade. You ask yourself the question, why did I enter the trade? You should be able to have a clear-cut answer why you pull the trigger for a particular trade. You also should be able to know how to place your stop loss. It should be objective, not subjective. You should have a rule-based, a clear-cut rule on how to place your stops in every situation, and the same thing applies to your targets. Now, talking about strategy, you need to backtest your strategy. Most people will give you enough sample space of about testing 100 trades on a particular pair on each time frame, just for you to see the profitability of your strategy. Finally, staying disciplined is easier when you have a tested, trusted strategy and a good risk management plan. So once again, thank you so much for your time, for being with us in this session, and I just believe that you have been able to learn 1 or 2 things. This is a very powerful video, in my own opinion. It's a video that will make you stay alive in forex. If you know the concept, you will never be afraid of blowing your account. You'll be able to over time, take care of your human greed factors and so on and so forth. Okay, so it's very important. I cannot emphasize these few concepts I've been able to bring to your notice today. It's so helpful. It's so helpful and important to any trader who wants to take trading seriously. So if you find the content useful, do not forget to like and turn on the notification bell and subscribe to my YouTube channel. Once again, thank you, and I wish you the best.